Hello, this again is Joe Hoyle, still at the University of Richmond, still talking about financial accounting. Today we begin talking about inventory. Inventory, of course, for many companies is one of their very biggest assets. If you go to a grocery store, if you go to a department store, they have clearly lots of inventory because that's what they want to sell. And how many problems can you have with that inventory? In our first video lesson, we have a real interesting situation, different than you normally think about. We're going to talk about a different type of accounting, which is forensic accounting. And forensic accounting, it's somewhat like Sherlock Holmes accounting. They try to figure out information when the information is not available. Now, if the information's there, if you kept a journal and you kept a ledger and everything works correctly, then it's pretty easy to make a set of financial statements. But what if the information is not there? Now, in this case, your roommate's parents own an ice cream store, and in one of those stores, the power goes out and all the ice cream melts. And they go to the insurance company and say, we want insurance coverage. We want to be paid for the ice cream that has been destroyed. And the insurance company says, how much ice cream was there? Now, all of a sudden, there really is no good record for that because the ice cream has all melted. What do you do in that situation? Well, a forensic accountant would come in and try to figure out, based on all kinds of different ways to manipulate data, how much ice cream was actually there. Now, let me give you an example of how they might do this. If you go to the company's ledger, you should be able to determine what they had on the first day of the year as ice cream, the beginning inventory. That will be there. You should also be able to go through the accounting records and find out how much ice cream the company had bought before the electricity went out. So we might know that they had $10,000 to begin with, and then they bought another $100,000. But clearly, they didn't have $110,000 in inventory when the power went out because they sold a lot. So the question is, how can you figure out, how can the forensic accountant figure out how much inventory was actually there when the power went out and it all melted? What would you do in that case? I always tell my own students that the three most important words in accounting, or at least in an accounting class, is figure it out. Is that what we're trying to do is to figure out how we can take the information we have and find the information that we want. We know they had $10,000 of ice cream to begin with, and we know they bought $100,000 more, but they sold some. How much of that ice cream did they sell? Well, if you go to the company's ledger and look at the sales account, you should be able to determine how much they sold during the year. Let's say $140,000. But now that's not a cost number. That's what they got. How much was the cost of goods sold if they sold $140,000 worth of ice cream? Well, the company then, or the forensic accountant, could go back and look at the past years. For most companies, the gross profit percentage, and we've computed the gross profit percentage before, it's the gross profit divided by sales, tends to be fairly consistent. If a company has a markup of 40% one year, it's probably going to have a markup of 40% every year. It will change some over time, but it doesn't change too much. So let's assume that the forensic accountant goes back into the records for the last couple of years and says in most cases the gross profit was 50% of the sales price. If you sold ice cream at $2, the markup was $1 and the cost was $1. So anytime that you know the gross profit percentage, you can find out the cost percentage. So if the gross profit percentage was 50%, then the cost would have also had to be 50%. Therefore, if this is the way it's worked and we sell $140,000 of ice cream and the gross profit percentage is 50%, then that markup is $70,000. Sold $140,000, marked up $70,000. What did the ice cream cost? The ice cream cost $70,000. Now, we don't know that for sure, but that's a very educated guess that the forensic accountant has made. We had $10,000 to begin with. We bought another $100,000, so we would have had $110,000 at cost if we had sold none. But we did sell some. We sold $140,000. But that's a retail price. How much did it cost? Well, based upon the gross profit percentage, we believe that cost was $70,000. So that ice cream is gone. Some little kid has eaten all that ice cream. How much ice cream was there when the power went out? They had $110,000. We believe they have sold ice cream that cost $70,000. So therefore, our best estimation, if we're the forensic accountant, is that there was ice cream there costing $40,000. So a legitimate claim that your roommate's parents could make, if these facts all worked out, was that they lost ice cream that cost them $40,000. One of the things that I really like about financial accounting, one of the things I like about this course, is it shows you that once you get used to looking at the information, there's a lot of things you can do with it. In this situation, it wasn't just talking to outside decision makers about buying stock. We were using the information to help the company internally. They had a problem. They had an insurance claim. And we were able to take the information and come up with a reasonable estimation of the amount that was destroyed. Once you have the knowledge of the information that's available, it's amazing how many uses you can make of it. This is Joe Hoyle. This is the University of Richmond. This is Financial Accounting. Have a great day.